Hello, and welcome to the video on inventory costing and inventory ratios using PepsiCo's 2017 annual report. This corresponds to video 2 in week 2 of Foundations of Financial and Managerial Accounting and chapter 6 in your text. We illustrate concepts in your text with real financial statements to show that they're a little more complex but follow the same general format. This way you get more comfortable with real financial statements. So inventories are an asset, a resource that provide future benefits since they are used up or generate cash within an operating cycle. Remember, you can sell inventories, collect receivables, and get cash. These are current assets. For PepsiCo, has inventory of $2.947 billion on December 30th, 2017. So it's a little less than 10% of its current assets. It doesn't have an inordinately valuable inventory selling, foods, as opposed to, let's say, Tiffany might sell diamonds for resale. So how are they accounting for it? Your book talked about several accounting methods, and in order to do this, we must look in the footnotes. The first footnote we look at is the one that describes significant accounting policies. All companies will tell you this, that they use the lower of cost or net realizable value, which your book calls lower of cost or market. Before we say anything about the costing method, if the costing method you use causes the inventory to be worth more than what you could sell it for, mark it down. But for most companies, they can't stay in business too long if they're always buying things that won't sell for more than what they bought them for or made them for. So this only applies when things are bad or when you have obsolete or spoiled inventory. Normally, cost is determined using the methods discussed in your text, and you might be surprised that PepsiCo uses all three of these methods: the average cost method, the first in, first out method, called FIFO, or the last in, first out method. A company the size and scope of PepsiCo can use more than one inventory accounting method for different types and locations of inventory. So if you're only selling one thing, you'd use one accounting method. But PepsiCo sells many things: snack foods, beverages, juices, breakfast foods. So let's look for more details about this. Note 13 tells us more about the types of inventory PepsiCo has because they make their own inventory. They're a manufacturer. And of these types, there's raw materials and packaging for about $1.3 billion. So it might be sugar, it might be syrup, it might be oranges for orange juice. There are many different things. Work in process are when you've started to make a product, like let's say you baked a batch of cereal, but it hasn't been packed. This is very small because the manufacturing process for PepsiCo is very quick. And then finally, we have finished goods. Finished goods are $1.436 billion, which is a little bit less than half of inventory. This inventory can be sold to customers. And for PepsiCo, customers aren't just directly me and you. Oftentimes it's Walmart or supermarkets or schools before they get to you. So let's talk a little bit more about this costing method. And we said that PepsiCo uses three different costing methods. Well, if you use FIFO, first in, first out, LIFO, last in, first out, you have to provide information which your book calls the LIFO reserve, the difference between ending inventory FIFO minus ending inventory LIFO. Well, PepsiCo uses this last in, first out method, but for such a small part of its inventory, it doesn't even matter. They only use it for 5% of inventory. So they did not need to report a LIFO reserve. If you think about it, PepsiCo's inventory is valued most when it's fresh, so they try not to make too much inventory. Nobody values stale chips or stale soda. So other companies, they might have to disclose this, and U.S. companies that list on U.S. exchanges can use the last in, first out method. companies using international financial reporting standards, in Europe and in the EU and other places, you wouldn't see this. So what can we do with this information? We want to find ratios that describe either liquidity, solvency, or profitability. The inventory turnover ratio is a measure of liquidity. To get this, we need not only the inventory from this year's balance sheet. We said inventory last year and inventory this year. If we're going to get an average, take the two, add them up, divide by 2. But we also need cost of goods sold from the income statement. A liquidity ratio, like inventory turnover, says, can a company generate cash to pay its debts in the short term? Sales of inventory usually lead to cash. Sometimes you have to wait to collect receivables first. But companies like PepsiCo don't give their suppliers or their customers very long to pay on account. So let's look at this. PepsiCo has inventory turnover of 10.15 times in 2017. This means it sells its inventory 10 times a year on average by comparing the ratio of cost of goods sold to average inventory. That's a little over once a month. Notice that in 2016, it sells the inventory 10.37 times a year, or a little bit more. So higher inventory turnover indicates more efficient inventory management. Using inventory turnover, PepsiCo was slightly less efficient in 2017 because it didn't turn over the inventory as quickly as it did in 2016, but not by much. A way to make people understand this ratio, which is why your book shows inventory turnover as well as days in inventory, is to convert the inventory turnover ratio by dividing it into 365 to get days in inventory. So you need the inventory ratio calculated on the prior page, which used the current year's income statement and the current and prior year's balance sheet. Like the inventory ratio, it is a liquidity ratio, measuring the short-term ability of a company to pay its debts, and it's interpreted in the opposite direction. We said before, higher inventory turnover is good. Well, higher inventory turnover leads to lower days in inventory sitting around on a company's shelves. So higher inventory, which leads to lower days in inventory, means you're more efficient with inventory management. In 2017, PepsiCo was slightly less efficient in selling its inventory. It took every 36 days instead of every 35 days in 2016. I hope this video will help you before looking at other companies' annual reports for the weekly discussion board. Good luck and get started, Jaspers.